Welcome to the Brent Bruce Daily for March the 13th, 2023. It is now 4:55 p.m. Central Time. There is a lot going on that we're going to talk about here in just a minute and how the disruption in the market right now is affecting home loan interest rates. I am currently in Gulf Shores, Alabama. It is spring break in the South, and I am down here enjoying this beach as well as a baseball tournament that my two older sons are playing in with their high school baseball team. So having a good time with that. But there's some people that are not having a good time right now. Some people that are unfortunately experiencing the failure of Silicon Valley Bank. And here's what we need to talk about. We have talked almost entirely about inflation for the past year. But I have mentioned that anything else can come in and affect home loan interest rates as well. If inflation was steady, if we were at a steady 2%, I would still have a video for you every day because there's always something else affecting home loan interest rates. Now, this is what's going on with the insolvency of Silicon Valley Bank. Okay, so unfortunately, when something like this happens, it sends shock waves throughout the whole economy. Okay, this is not just one bank that is failing. They do business with hundreds, maybe thousands of other banks and institutions. Many people depend on them for their banking, and they don't even know they do because the bank they're working with has some other agreement with that bank. So this stuff can create, unfortunately, what's called a contagion, where one bank might fail, the next bank might fail, and it might snowball into a worse situation. So people really start to freak out. Okay, so what's going to happen and what is happening right now is that people will say, when there's fear in the market, what do you want to do? You want to take your assets kind of off the table. I've mentioned that many times. So they want to remove their assets from positions of risk and they want to move it into positions of safety. Okay, so in this instance, people are saying, look, I want to take my money out of the general equities and stock market, and I want to put it into a more safe investment. Well, one of those safest investments out there is going to be bonds. Okay, so if you put your money into bonds, it is safer. It has a fixed rate of return, and people tend to feel more comfortable with their money moving into bonds. And that's what we're seeing on a major scale, is that people are taking money, moving it into the bond market, which creates demand. And like any product, when you have demand, it changes the price of the product. Okay, so understand that millions or billions of dollars are moving into the bond market, buying the 10-year treasuries and mortgage-backed securities. They're buying mortgage-backed securities, which when you have demand, do you have to give a higher rate of interest or a lower rate of interest to attract buyers? A lower rate of interest. Okay, so if I'm going to say, hey, I want to borrow from you $1,000 and I'll give you 1% interest on that money. You might say, Brent, that sounds like a risk I don't want to take. But then I come back to you and I say, well, what if I give you 10% interest? Now you may be more interested because it's worth it to you to take that risk. It's the same kind of situation here, is that there's so many people that are trying to buy bonds right now that we don't have to give as high of a rate of return. There's enough buyers, so we're allowed to sell at a lower rate of return. So you see the 10-year treasury coming down and the mortgage-backed security actually improving in price, which is bringing down the home loan interest rates. Okay, so there's more detail to come. So let's take a look and see where we are on our mortgage-backed securities. We are currently up 78 basis points. What a great day. The 10-year treasury, take a look at that, down 14 basis points. I mean, how long ago were we concerned with the fact that we were touching on 4.0%, which I said we never want to hit 4%. But we were at 3.4%, a couple of weeks before that. So we went from 3.4 to 4% and now back down to 3.54 almost overnight because of the disruption in the economy. So this is where you see how all of these things matter and you have to pay attention all the time. So let's take a look at our charts here. We have shot up, broken through 1, 2, 3, 4, 5 ceilings of resistance and began to even start to head towards the elusive 200-day moving average. Now look at it. This is what we were fighting with. Remember we were talking about this weeks ago, now over a month, when we were at 5.875 on the Brent Bruce Daily, and we were celebrating that day. Now we were about to start flirting with that again, but we were pushed back down, and now we're under this Fibonacci level and under this 50-day moving average floating around here. So unfortunately, we have drifted back throughout the day. Why is that? Because we talk all the time about the fact that when big events happen, you're going to have a knee-jerk reaction one way or the other, and then things start to settle down. It's exactly what happened here. You saw a knee-jerk reaction. The markets opened up. Mortgage-backed securities went through the roof, and they have drifted back down. Now, again, we're starting to hear that they're trying to find ways of resolving the issue with Silicon Valley Bank. that they're going to settle the markets. The Federal Reserve might have to step in, and they're going to settle things down. And they probably will. So then people start to go, okay, I start to feel a little bit more comfortable. I don't need to pull all my money out of the equities market entirely. I'll settle back down. And the demand subsides in the bond market. And that's what we're seeing. So how is that affecting home loan interest rates? Let's jump over here. Now, you would think that on a day like this, 78 basis points, we would have had a huge move. Now, we had some good moves last week. We ended last week at about 6.5% on the Brent Bruce Daily when we started the week at 6.875. Okay, so we had a great week last week. So with this kind of a huge day today, let's take a look and see at where we are. Let's go over and run our scenario here, which again, this is the Brent Bruce Daily, is our very well qualified 30-year fixed conventional, 800 FICO score, 25% down, primary residence, single family residence. And look at this. Interesting. We are at 6.5% with a credit of 803. I mean, that doesn't even seem like we've improved at all. Let's open this up a little bit greater here and take a look, and we'll talk about why. Okay, so 6.375 is costing $752. To get to that 5.99, ooh, take a look at that. To get to the 5.99 is costing just over a half of a point. So sometimes buying points down is more effective than others. Like right now, we're seeing that if you're willing to pay 0.6, you're at 5.99. Now, you see, that's why you have to make sure that you're talking to people who know about the markets. Because if I didn't know to look into that, I would have just told you, well, looks like no points today is 6.5%. And I wouldn't have been able to look further to see that, no, 5.99 is at a cost of 0.654 points. You have to deal with people who know how the markets work. Now, why is it today that you have such a good day in the mortgage-backed security market, but you're seeing the no-point loan with almost no benefit from Friday? Because here you go. First of all, the banks, they're kind of waiting it out. Okay, they don't want to put themselves in a position where they run over, give you a 5.99% interest rate, and then in the morning we wake up and all of those gains are taken back because maybe the markets settle. Who knows what the Federal Reserve is going to do? You see, nobody really knows yet how this is going to settle. We don't know how it's going to end up. So the banks are going to say, look, if you want to buy a lower interest rate, we'll make that pretty available. I mean, for only 0.6, we'll give you a 5.99. But we're not ready to just start giving up all of our gains because we don't know what's going to happen yet with the market. So because we need some more clarity as to how the Silicon Valley Bank issue is going to be resolved and how it is going to settle, we're not seeing all of the gains. But here's what you need to know. Here's what you need to know. There is a whole bunch of gains built up. Okay, so when they feel comfortable, if they feel comfortable that things are going to go the way that they want it to go, they will unleash those gains very quickly. And you will see 5.999% with no points. That can come overnight. That can come overnight because we know that there's a buildup of profit, of gains in the mortgage-backed security market. So make sure that you continue to pay attention, watch the Brent Bruce Daily each day. If you enjoy this information, make sure that you like, subscribe, and share. If you think that I'm crazy, if you have a different opinion, let me know. Make a comment. I reply to all of them, and I get them every day. I have someone that just has different views, and we talk about that back and forth. But I look forward to hearing what you have to say, and I look forward to seeing how this plays out. Now, remember, we still have a consumer price index report coming out tomorrow. Okay, so the huge reports that we pay attention to when it comes to inflation, they don't stop just because something else happens in the market. We have even more to cover. I'll get back to you again tomorrow.